It's fine.
Good morning, everyone.
Good morning.
Morning.
Mahesh, José, thank you
Afternoon
for being
almost,
here.
yeah.
As I was preparing for this, José, I want to start with you. I noticed that Clearlake is turning 20 this year. For the vast majority of that time, you've been mostly a private equity firm. Then last year, you made 2 acquisitions to kind of increase your presence in credit. How is that integration going? How are you thinking about sort of that side of the business, given all the kind of concerns around credit and private credit in particular right now?
Yeah, of course. Again, good morning. I'm very happy to be here. Thank you, Bloomberg. So yeah, we're almost no longer teenagers. We're going to get to that 20-year mark. What's interesting about Clearlake is from the very beginning, the premise of Clearlake was built upon this idea that kind of the capital markets are more of a spectrum, a continuum, right? Rather than this strong delineation between equity and credit. So we always, even though we have private equity funds and that has been our core product over the past almost 20 years, we have always had a credit component. But certainly in the past few years, the world has changed, right? The world of alternatives has changed quite a bit. And with essentially the growth of not only credit, but private credit and hybrids along the way, we think the world looks a little bit different. So short version is that we think that the winners of tomorrow need to have broader conversations, deeper conversations with their clients. And those conversations need to encompass different solutions, bespoke solutions, credit, private equity, and everything in between. And the acquisitions of Pathway and MV Credit clearly position us to kind of be a more global firm, but also more interestingly a firm that can have those conversations across multiple products, multiple segments, secondaries, infrastructure, credit, private equity, et cetera, et cetera. So we think we're well positioned. But again, this is just the second decade, so looking forward to what's to come.
And to many more, obviously, but are there other areas that you would be interested in expanding into that maybe right now you don't have a strong?
Yeah, it's interesting.
You look out a few years.
With this, I think we have a toehold in pretty much all the significant parts of the market that we are interested in. But clearly, there's a lot more to do. When you look at the market, we'll talk about it probably today, but you look at private equity and the way it has evolved, and then you think about the secondaries market, a very small part of the private equity commitments really trade in that secondary market, right? And that's changing dramatically, and you can see that, kind of exploding in a positive way, meaning, massive growth for that secondaries volume.
Yeah. Mahesh, I want to bring you in with this because it's been, obviously there's been a ton of consolidation in the asset management industry. We've seen a lot of firms that expanded from the roots into equity into other markets and liquid fixed income managers getting into private markets.
Yeah.
How far along are we in sort of that process, and how much more consolidation would you expect to see sort of across that space?
Yeah, again, to the point that Jose made, right, I think one of the things that we continue to notice is the differentiation between public and private markets continues to compress, right? So it's happening from both sides. When we think of issuers, when you think of our clients who are looking to raise capital, they are more comfortable now than, say, 10, 20 years ago around a desire to look at both the markets, both solutions when it comes to kind of, how are they going to raise capital. And the same thing we are seeing on the investing side. On the investing side, we are seeing kind of sponsors expanding from monoline PE shops to like a much more diversified alts shops. Money managers like BlackRock, PIMCO, who are kind of more in the liquid public security management business, kind of getting more into, with the acquisitions that they've made, getting more into the private market. So I think we are still in the early stages of some of this consolidation that's happening. So I think our expectation is the industry will continue to evolve. I think we've seen some, but I think there is a lot more that has to happen because longer term, the winners will really be the ones who have a very diversified platform that can serve the entirety of the capital structure. So we think that's the direction of travel, and we'll continue to see more of that.
Yeah. And I want to get to that point about secondaries, but first to stay on sort of the traditional private equity for a minute.
Yeah.
It's been a tough environment for a while in terms of fundraising. do you think there is a sort of resetting of expectations for that industry and what returns look like, what fund sizes look like, what deal sizes look like?
The answer is maybe, a strong maybe. We have seen this before, right? Private equity has gone through different periods where, compared to specifically the public market benchmarks, private equity returns have potentially lagged, right? And oftentimes, by the way, those are the best times, the best vintages to actually invest and deploy capital. Most investors, it's a strong temptation. We look in the rearview mirror, and then we extrapolate. Oftentimes the world is different, right? And instead of moving in a nice smooth curve or line, you have step functions and sometimes jagged edges, to return. So I think, as always, though, private equity, what we have done well in the industry, if you look back at the past 20 plus years, is reinvent the industry every decade or so, right? What started out as really levered buyouts with a very heavy financial engineering component has transformed over the past 2-3 decades into being real stewards of companies, implementing real governance, implementing real operational improvements. And the laws of gravity haven't changed, right? Are interest rates higher than they were, 5 years ago? Of course they are. Is the economy perhaps going to be a little slower, maybe driven by significant disruption coming from sectors like technology, energy, AI, of course, being a big overriding factor right now that we're talking about, of course. But at the end of the day, our job remains the same. We buy companies, we try to make them better, hopefully bigger, hopefully accelerate that growth, hopefully in the process making them more strategic, more essential parts of that ecosystem. And if we do that, maybe not tomorrow, maybe not in 6 months, but I'm pretty sure that over a 5 to 10 year period, there will be strategic buyers, there will be other financial buyers, there will be continuation fund vehicle opportunities, all kinds of ways of exiting that are and we're going to be able to make money. Can I say, hey, we're going to make 5 times our money in every deal? Of course not, right? In a higher interest rate environment, do you think that on average, returns in private equity will be somewhat lower? Of course they will. But I think the opportunity in private equity remains the same. There's always an opportunity for good owners, particularly those that can add operational expertise, to make companies bigger and better. And if you can do that, you will be able to be profitable and make great returns in private equity.
What's your take? Is there a question of having a bit of patience?
I think the only point I would add there is, obviously it's a point in time question, right? Like, if you look at what's happening right now, there's 3.8 trillion to 4 trillion of assets that have been sitting in PE, PE funds for, call it 6 to 7 years, right? It's 30,000 plus companies. So there's always a tendency for markets to overreact to both sides, when things happen, right? When PE returns were really good, everyone was like, PE is the best thing in the world, we're going to invest heavily in it. Now, over the last couple of years, obviously when DPI has been lower, when some of the exits, again, a lot of this is vintages, 5 to 6 year ago vintages, exits have been a little bit slower. I think the market will probably tend to overreact a little bit to the other side. Is this kind of the the phase where PE, the PE shops will have a tougher time? I don't think so. I'm with José on this in terms of longer term. I think there is a need for that type of capital in the market. I think people will change the way they underwrite, right? Because if you look at the exits through public markets have gone down dramatically, right? The IPO market, again, obviously we're nowhere near what we saw in 2021 in terms of 400 plus billion that was raised in through the IPO market. This year maybe we'll touch 200. So as the IPO market is demanding a different type of companies to kind of be in the public domain. So I think as investors underwrite and the assumptions they make around exits, the assumptions they make around the returns that they want, they might change a little bit as we kind of go through this transition.
Is that just on valuation or debt levels or,
I actually think on debt levels, it's not a problem. If anything, again, I'm sure we'll go into the private credit space at that point, but the availability of debt is as good as it's been. We can, of course, the last 1 to 3 weeks felt a little bit different, but if you take a longer horizon, I think getting debt actually continues to be fairly available.
Easy
so
part.
yeah, it's the easy part, right? It's really the exits. It's really the volatility around the exits, right? Like you underwrite to a base model, but if that doesn't happen, then how much cushion do you want to leave and what are the returns you want to make? So those assumptions will get tweaked and the return expectations might be higher. But point in time actually is a great, if you have a secondaries fund, it is a very interesting and exciting investment opportunity.
Yeah.
Right? So I think, I do think, again, some assumptions might change, but on a longer horizon, this industry will continue to kind of tweak assumptions, but still be a very, very profitable business.
Yeah. And Jose, how are you thinking about exits in this environment? You mentioned continuation funds that have become incredibly popular. I think they've been gradually more accepted by LPs as well. There's different versions, multi-asset, single asset. How are you thinking about that space?
Yeah. Well, maybe as a continuation of what I mentioned before, our job is to buy these companies, make them bigger and better, and then exit the companies. And there are multiple ways of doing that. People oftentimes say, well, the preferred way of exiting is XYZ. Well, the preferred way of exiting for us is whoever pays the highest multiple, whoever pays the highest price, whatever generates the highest return to our investors. At different times of the cycle, that may be different. And there are times in the cycle, and particularly with some companies where strategics are more active. Oftentimes, financial players are more active, and sometimes the IPO market or equivalents, right? Kind of we saw SPACs, for example, for a while had a little bit of a renaissance, and then they retreated a little bit. Continuation vehicles to me is just another private exit. Here, you're substituting maybe perhaps instead of another sponsor, you're substituting perhaps a group of secondaries players, right? That are leading that transaction, and then with the help of maybe rollover capital or even kind of existing funds. I think it is a legitimate way of exiting, particularly the way we did it. Our version, our flavor of continuation funds, or at least our aspiration was to do that with kind of the best of the best companies that we were confident that we wanted to own for an additional kind of phase of growth, where that continuation vehicle could be a catalyst for that growth, meaning that that additional capital could be used for acquisitions or whatever was pertinent for that company, and then obviously ultimately get to an exit. And we have done that, kind of partially, and in some cases, kind of totally. But I think you have to look at it on a deal-by-deal basis. It's no different than private equity. There will be some continuation funds and some companies that are great candidates for continuation funds, and some that perhaps are not. And you have to look at it on a company-by-company basis.
Right. And we've seen a couple situations where maybe that hasn't worked out, but it doesn't kind of detract from the idea that
if you're taking risk, by definition, not 100% of everything's going to work out. At least
Absolutely.
I've been in this business for a long time, have now a little bit of gray hair, and that's my experience.
I have more than you, so you're still doing fine.
I don't have any hair, so I don't know if we should be.
I was just at a conference in Las Vegas, structured finance event. There was a lot of talk about sort of solving for some of these issues that maybe are temporary, whether it be fundraising or liquidity or even returns, with structured products like CFOs, rated feeders, and all of that. Mahesh, I'm curious to getting your perspective on like what kind of conversations you're having with clients on that front, and what's that kind of like the new frontier of that of those type of products.
Yeah, definitely. So I would say, when we speak to clients, right, there is a continued evolution of the industry, right? It started with kind of you start doing NAV loans on your positions as a way to like do a DPI. Or by the way, NAV loans started when the leveraged finance market was shut down for a little while. So instead of taking a company by company, you start doing portfolio, you did NAV loans. That was kind of one way, one innovation that happened probably like 3 or 4 years ago. Rated feeders, CFOs, I think all of these, the way I think of it is a little bit more of different ways in which you can get capital into the private markets, right? So these are all, these are all kind of instruments, especially some of these are very well suited for insurance companies, right? Yeah. So as insurance becomes much bigger player in the alts portfolios, they are getting financially savvy in terms of the investments they want to make. So the result of that is the evolution of all these products, and we are seeing continued growth. If you look at kind of the total quantum across all of these types of capital raise that has happened across rate of readers and CFOs, I think that continues to grow. Our projections are that that will be another tool that will be available, especially as we said, the presence of insurance companies in alts portfolios grows. So we expect our clients, and we are seeing again as with anything, right? When something new happens, some clients are very hesitant to use, some clients are very open to use, but over a longer horizon, I think adaptation, if the product is successful, will be there. But right now we're in that phase of like education as opposed to like fully adapted when it comes to some of these products.
Right. Does it feel like it's a bit of a temporary solution to maybe plug a gap until an exit, or you expect this to become something that's just embedded in how these markets work?
Again, obviously, I've been around these financing structurings for so long. You go back in time when people started doing capital call financing, right? People started doing just kind of like, borrowing against you.
So basic now.
Yeah. At that point, I remember a lot of debate around like, is this financial innovation or is this something that will be adapted by everyone? And today, that's a $1 trillion+ market, right? That's just like so my view is, some products will become like that. Some products will at some point kind of fade out. But I think more of these, I think in my mind, will probably some things that will exist for a longer time.
Yeah. We've had a lot of conversations at this event about sort of where the capital is going to come from. You mentioned insurance and that interest in private markets. Jose, I'm interested in getting your thoughts on the sort of retail side of the picture. There's a lot of discussion about giving retail investors, including all the way into 401ks, kind of access to private markets, whether it be private equity or private credit. Yeah. Is that a good idea? As someone who runs a private equity and credit firm now, how do you think about that?
Sure. Perhaps the natural instinct for people on my side of the table is to say, yes, of course, any new source of capital is good. I think we have to be very careful when we talk about this, because first of all, to me, it all starts with we have to be client-driven, right? Kind of what are clients looking for? What is it that they want? What is it that they need and want, right? This is not like medicine that we're giving it to them because it's good for them, but they don't really want it. I think, so we have seen a massive evolution in the retail markets, and those have evolved, right? Kind of traditionally private equity funds, for example, have been offered for a long time, in the large private wealth, kind of ultra high net worth networks. We're talking about a much broader democratization, right? I think my own view is that some of the products that are going to be most suitable for that retail market may not be pure play private equity products, at least not initially. There's also an educational component that comes with it. But I think there's some products that, of course, certain flavors of credit, very well suited for the retail market. Secondaries, again, flavors of the secondaries, it could be really well suited. Infrastructure, perhaps. Even private equity, maybe kind of in a different package, in a different flavor. I think we need to be very careful about how to communicate. Things like liquidity, duration, all those type of things need to be very clearly delineated for that retail investor. So I think it's great, kind of to be able to do that. I think alternative products do belong in a diversified portfolio, kind of in the context of that retail market, particularly as you get to kind of larger portfolios or higher net worth individuals. But we just have to be very careful how we do that. We have to be very careful that we meet that demand from that client, but also communicate very clearly, the risks and benefits of those products. But I think it's here to stay, and it's certainly a growing market and one that we're paying real attention. And in some ways, our acquisition of Pathway was a little bit thinking about that product, not today, but thinking about the demand for products in the next 5 to 10 years.
Down the line. Mahesh, we're seeing a lot of kind of discussion around private credit and that push into retail maybe as the precursor of a bigger push across private markets. What do you make of the situation we're in right now, and particularly with the structure of some of these funds? We heard yesterday a lot of commentary around this 5% cap on redemptions. That's a feature, not a bug. Yet a lot of funds are kind of allowing more than that to be redeemed. Is that kind of mixing the message in any way? What's your sense of what ultimately investors understand?
Yeah, I'd say, if you got to take a step back and look at the evolution of the private credit market, right? Like the private credit market really evolved post the global financial crisis, right? When banks wanted to do less and less of leveraged lending, that's kind of one of the first steps where a lot of these private credit players emerged. And what is the core thesis of doing a private credit loan? The core thesis really was you can go to the broadly syndicated market and you can get kind of a standardized documentation with like a spread, or you can do more bilateral in a smaller space, but where you are kind of doing a bilateral transaction with a smaller set of people and you're getting paid a risk premium, but in return for that risk premium, you are selling liquidity, right? So the core premise of the starting of what the private credit industry was, you can do something where you can get a premium around versus the public markets, right? Even today, if you do a private credit loan, you are getting a premium versus the public market. But in return, by definition, right, like nothing is free in the world. So in return, you are willing to sell the liquidity option because on a longer horizon, you're betting on the credit, not the short-term volatility of the spreads.
But I guess the question is then, is the push into retail then undermining that?
I think that goes to the point that Jose made, and I truly believe in, is it's all about education, right? I think again, I know one of my colleagues made this comment yesterday around, I truly think it's actually, if you want to protect the investors, the LPs who in this case happen to be retail, a fire sale of a private assets is not the way to do it, right? So this 5% cap, actually, what does it ensure? It ensures that there is an orderly liquidation that actually gets the risk premium that you paid for capture, right? So I think there is a little bit of a confusing messages sometimes around, at the extreme, if private credit is traded on a daily basis, then that's public credit, right? So we just need to kind of be a little bit clear on our messaging is, if we have more and more retail coming into all these private markets, I think the expectations have to continue to be set around the liquidity is what you're selling, but to get the higher risk premium. And I think sometimes that gets lost when you kind of do these quarterly liquidities, and I think that's what's causing a little bit of, we saw this in the commercial real estate space about 2 years ago, right? Kind of a similar trend. So I think that is exactly what's happening today. But I think, again, as I said, it's all about messaging to the audience.
I want to touch on sort of software and AI. We've seen a lot of concerns in that space and disruption. If you look at the public markets, I know Clearlake is a big investor in software as an industry. So I'm curious, Jose, what are you seeing from your seat?
Yeah. Well, of course, the past 45 days, the market has really come to this realization, kind of that, hey, software, the business of software, the model might change, right? And the markets reacted very negatively because it adds uncertainty in a part of of our economy, right? That historically, or for the past 15 plus years, has been seen as kind of the growth engine and a fairly clear, secular growth path. And now AI kind of brings that to a big question mark. Like we have been talking about, the markets overreact sometimes. I think the reality is that there will be some software businesses that are extremely vulnerable to AI threats, kind of both from a software development perspective, but kind of go-to-market perspective. If you are kind of a tool that sits, kind of on top of data provided by others, you're going to be very vulnerable. There's going to be some companies that are AI native, right? that are incorporating everything that we know about AI today, and kind of in the future, those companies are going to be very valuable, and there will be several probably trillion-dollar companies, right, that are created from that. There's a fat middle, as I call it, of companies, software businesses that are extremely good businesses. Their growth profile may change a little bit. The way they develop software may change a little bit. But the reality is that they are embedded in their ecosystem. They have the customer relationships. They perhaps have the nexus between suppliers or different parts of the ecosystem. And AI may become just a much more efficient way of developing that software, right? And it's interesting to note that in software, right, not always the best product wins, by the way. And AI today, at the very least, can accelerate that software development dramatically, right? You can go from a team that was like 20 people that would develop a product over 6 to 12 months. Now you can do that maybe with a team of 5 people over 2 weeks. That's dramatic. But at the end of the day, you need to have the customer relationships. You need to understand the business process around that. And the incumbents are going to have an inherent advantage. Whether or not you should pay 20, 25 times EBITDA, or 20 times revenue, or 10 times revenue, or 5 times revenue, that is a really interesting question. But the reality is that it's a target-rich environment today because there's a lot of that uncertainty, and people that understand software understand this type of evolution like us, where we have invested over 20 years in a broad range of companies, some that are growing very fast and some that are growing more slowly. There's going to be a lot of opportunities there.
Yeah, Mahesh, how easy it is to underwrite deals for software companies right now, and to kind of figure out in which bucket they fit. I'm going to blend in some of the questions we got from the audience here, but the pace of transformation is so rapid that how can you be sure which companies will be a good bet and which ones won't be?
Yeah, I would say again, I think it's not, software is definitely the flavor of the last 3 weeks, right? But it's not just a software issue. Like from an underwriting perspective, right? What's happening with AI is a transformational thing that's happening that's going to impact many other industries, right? Today it's software, and there's a lot of discussion. Tomorrow it'll be in some consumer businesses where there's commercial receivables. There's a lot of places where I feel the disruption of AI is going to happen. So it is very challenging to underwrite, and some cases actually will be where there'll be a massive beneficiary of the AI wave, especially data, right? As anywhere where you have access to data, anywhere you have proprietary data, that's the places where benefit from AI. And some places will have a massive tailwinds from AI. So from an underwriting perspective, I would say this is as complicated as it has been, because this big unknown of what you assume is kind of AI proof is rapidly transforming, could be an AI proof, or what you assume could benefit from AI might not. But having said all that, I think, again, not all software is the same. Exactly the point is, there is a lot of differentiation in terms of if you have a vertical software integrated company, that's much different. So we do have, a lot of clients that are asking a lot of questions around segments that they are very familiar with, segments that they think they'll benefit. But again, I want to keep going back to the point. It's not just software. It's other industries that are getting disrupted that will get a lot more attention. So underwriting overall is because we are into a world for the next 6, 12, 24 months, there's going to be a lot of unknowns. So it is going to be a challenging time to underwrite things.
You said it's as difficult as it gets, but to what extent is that sort of really preventing deals from happening? Like if you can't figure out the answer immediately, does that mean that deal? I think
the way it will manifest itself over time is in terms of risk premiums, right? Because our clients will then want anything. We are seeing that in real time, where there is some delta around the outcomes, the risk premium that clients are asking are going to increase, right? For a long time, credit curves were pretty flat, right? You didn't get rewarded too much for going out in credit or going out to equity, right? And that's kind of what we are seeing. If you look at, kind of again, single name stock vol is higher than what it used to be, because the market is saying that underwriting single names is going to be more challenging than what it's been, and credit curves will continue to steepen out.
Yeah. By the way, quick comment. I think that's interesting to us because the dispersion of returns is going to be higher.
Yeah.
So better stock pickers, people that understand the industry and the company well, are going to do better. We think we're well positioned there. Number two, I see some comments from the audience about LLM's reasoning. They're not quite there yet. LLMs basically are based on data. So whoever controls the data has a better sense of capturing the rents derived from that data. And the LLMs right now are basically capturing really interesting correlations and relationships in that data that are not obvious to mere humans, but they're not quite reasoning just yet.
All right, we're out of time, but I can't show my face in Europe without asking Jose about Chelsea.
Wow, I thought I was going to do a panel about Chelsea.
Obviously, it's been a bit of a rough ride. The club reported a big loss, but sometimes you have to spend a lot of money to make a lot of money. I'm just curious, where are you sort of along that path, and how are you seeing that?
Well, we just won 2 trophies last year, so kind of it depends a rough patch for whom. Arsenal hasn't won in 20 years that I have checked. Or maybe they won something, but anyway, so we just won 2 trophies. We're in the fight for the Champions League this year. The reason that we have to end this panel is that there's a match in an hour or so.
Our stuff.
I think very simple, right? First of all, if you own a sports team or a club, you have to understand that you're a steward of something much broader, and the impact in the community is much broader than just a business or just a sport. Second of all, kind of we take very seriously that kind of Chelsea has been a top 6 in the Premier League, and we intend to not only stay there, but we intend to compete for trophies every year. We intend to win the Premier League someday soon. And I think the reality is that I think we have put in place a much more sustainable system in terms of players, in terms of kind of development, that I think is yielding results right now. So we're excited about the season. It's a very tough league, the toughest league in the world. We're fighting to be that top 4 or 5 with kind of names like Liverpool, Villa, United, and I think we're going to do well. But it's sports, so everybody has an opinion.
And you both have been a good sport. Thank you very much. Please join me in thanking Jose and Mahesh for their time.
Thank you, Jose. Thank you.